You got to accept. Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Friday, October 29th, and that means we bring on our good friend, Stephen Dow from Velocity Mortgage. How you doing, sir?
I'm doing pretty good. And yourself, brother?
I'm doing great, man. So it's an interesting time. But before we get into the topic number one, I want you to do the whole little legal mumbo jumbo so we both are protected.
Yes. So again, although I work happily for Velocity Mortgage Capital, all the ideas and topics discussed on this channel are that of my own. So let's get it cracking.
Yeah, the first thing I want to talk about, Stephen, is if somebody's been following my channel, I've been talking about rates going up.
Right.
I don't know how fast, I don't know when, but I think they go up from here. Right. I think that's
I mean, we're at historical lows, so there's really not much else to go up,
I just don't see the 30-year having a 1.99, right? Is it possible? Sure, right? But who knows? But I want to have just a general conversation because again, you're a non-QM lender, non-qualified mortgage. You're in the business of sourcing loans and selling them and all of that. There is obviously some, I'm going to call it a loose connection, right? As the 10-year goes up, a lot of investors watching the channel are like, hey, my 30-year mortgage got more expensive, right? There's kind of a direct correlation. I want to talk about the non-QM space, just in general, right? You've been in that space for a long time. Is it fair to say that as the Fed raises the funds rate, as the 10-year goes higher, it's fair to assume that your rates will adjust, maybe not one-to-one, but they'll go up as well? Is that a fair assumption?
Well, I mean, at some point it will get affected, but it's not indirect. It's not direct, just because we're not really tied into the 10-year Treasury.
Right.
So there will be, some overflow from that market over into ours, just because of speculation of where the market's going to be, yield, and all that good stuff. So I would imagine, it's going to affect us just because
at some level, right?
Yeah. Because everything's kind of intertwined as far as like a world market, world economy. So something's going to happen at some point, but it's not a direct move. So we're not that sensitive.
Right. Yeah. There's no rate lock or if you will. Right. So again, I think that's a really important thing because again, I talked to Matt, the mortgage guy, as you know, on Wednesdays.
Right.
He has this saying of like it, lock it, because his rates can move. I mean, he told me about a day, I think it was a month ago, rates moved 3 times in a day. Right. Now they didn't move a lot, but they did move. Right.
Right.
So again, bank money, those first 10 loans, owner-occ loans, we get a wacky day in the 10-year Treasury.
Oh yeah.
That will ripple through, and it will be immediate, nearly immediate, right? It'll be same day. That's not the case, right? So again, I think I talked to Matt, the mortgage guy. I think it was this week. It might've been last week, where rates moved. I think he said 39 basis points, which basically equated to an 8.
Right.
And what I wanted to talk to you about is I did a loan with you, ARV, what do they call it? The 50 program, ARV 50.
Fast 50. You're always at 50% or LTV less.
Which allowed me by buying a point to get a rate of 3.99. And that was like 8 weeks ago. Right. And what I really wanted to highlight here is you still offer that program. Nothing has changed, right? Even though, Matt's, wonky changes every day, perhaps your program hasn't changed. So there's no direct correlation.
None whatsoever as far as pricing wise for rates, because again, not directly tied in that market. Our section of the business is doing great.
Yeah, of course.
Again, it's all about leverage. That's what makes us go, our world go around. So just because you could verify their income doesn't really, prove their willingness to come back,
That we've seen historically where that could go away in a heartbeat.
Definitely.
So the other thing I want to highlight in the non-QM space, again, I'm trying to help people on the channel see the connection between bank money and non-QM money. I think it's an important thing, right? So first off, rates change up or down a lot more frequently with a bank, like perhaps daily, perhaps a couple times a day. Your space much slower, but it's fair to say that if this trends higher and higher, this will be affected, but it's not immediate and it's not a direct correlation. The second thing that should be obvious is the bank money, Matt, the mortgage guy money. They have a box, right? What do they call it? The online qualifier, online approval, or whatever.
Oh, it's a desktop originator.
Desktop originator. Yeah. It has a box, and the Fannie and Freddie, they could add stuff to that box, and the banks can add what they call overlays and all of those things. So they have the ability to kind of tighten or loosen that box as well, besides rates. So are they being aggressive or are they being conservative? So again, the bank, and again, you sometimes get the announcement like, hey, FHFA they added like a half a point to investment loans. Remember when they wanted to reduce investment loans?
Sure.
From like 13% to 7 or whatever it was. So they do that as well. In the non-QM space, what I have seen historically is it's certainly, I guess there are some changes. Like I know recently you lowered the lower band for credit, right?
Correct.
Right. Slightly, but still lower is lower, right? But again, it's not as immediate. I think it's fair to say. Is that true?
Correct. Well, I mean, in this case, we actually expanded our guidelines. We used to be 650 FICO or higher, but we've seen that, in many cases, people just have hiccups in their situation that were totally out of their control, but now they're back on their feet and they're, kind of looking for an extra helping hand to try to stabilize things when things are on the upswing. So we can kind of see that. We just lower the leverage position just to kind of, offset the risk. To reward level, so to speak. So
you're
we should do it.
When I gotta be careful, right? The non-QM space is essentially, I don't know, a risk arbitrage, right? They're a make sense lender, if you will. It's not just, hey, check 17 boxes, yes, you're good or bad.
Right.
Non-QM is more, hey, we'll look at the deal, we'll look at the person, we'll see what's going on. Right. Is that fair?
It's a whole big picture kind of perspective, because if you have compensating factors that are really, really strong, I mean, you've got millions in the,
No, keep going.
Puppy boy battle royale.
But I don't know. They were too loud for me, so I got irritated. So I grabbed the first one I could. This is Sunny.
Thanks. Hey, Sunny. So again, as far as how that would, I guess, get affected. There's really no direct correlation.
No, there isn't. It is the borrower and the deal, right? Compensating factors, make sense lenders, right? Like for example, on the lower credit, right? A bank would say, like, if their threshold's 620, somebody's 618, that's a no, right? You're like compensating factor. Well, it was up from 580 here. Their job, they got a whatever 2-year contract.
It's typically the amount of experience. To some degree, your reserves as far as possible net worth, and then just leverage position. Because again, risk reward. So if we're going to go all the way down to actually 600 FICO, but I'll limit you to 60% LTV, I still feel comfortable in that range. And statistically, what we've seen, even in the 600 FICO, if you're 40% into it as far as equity wise, you typically don't default even at the 600 range as far as FICO score. So we're okay to take that risk because we've got a bunch of data to back us up.
Yeah. And again, it's that whole make sense lender. I think a lot of again, I'm trying to compare for the audience in this conversation, banks versus non-QM.
Right.
Banks are very, I'll call it rigid. Non-QM it's like art and science almost. Oops.
Sorry about that, Mike.
Sorry.
Sorry about that.
What is going on? We got highlights from MMA or boxing.
No. Something just sorry about that.
That's okay. It happens. So again, what I'm trying to show is non-QM is more art and bank lending is more science, right? It's more rigid and whatnot. So
100%, because again, it's a computer.
Yeah.
Looking at your file.
Yeah.
And if it's the box or it doesn't, whereas there's an actual human being who touches your file and looks at all the other aspects about somebody's life. So there's, some cases you go through stuff that's just totally out of control, but you're not back on your feet, but you've got other aspects of your life that are, again, a compensating factor. Great reserves, a bunch of other properties where, they're cash flowing. So we're not that afraid because you're going to make stuff happen to try to, mitigate the gaps.
40% of skin in the game, you're going to do everything you can to pay that.
Oh, yeah, exactly. 100%. From, again, statistically, what we've seen, very small default rate. So we're comfortable in that range for right now.
Yeah. And then again, just the best example of that in today's environment is self-employed. Right? Self-employed borrowers, without question, have had an extremely tough time getting bank money. For you, it's like, we can do that. We do that all day long.
All day. No tax return, no pay stub, none of the old you know what? I want this stuff from you. I want you to explain this. Because people have really complex, entities set up and K1s and stuff like that. So you know what I'm talking about. They put you through the ringer, I'm sure.
I'm sure. Yeah. So that's what I want to talk about this first episode. Just again, the point of this episode is if I see rates going up, bank money will be affected first. In addition, we have banks being tighter or looser. Non-QM is more the make sense lender. So folks, certainly if you're self-employed, you have more than 10 loans, you want to do a blanket or portfolio loan, reaching out to Stephen Dow at Velocity Mortgage is a great idea. How do you want them to do that?
sdow@velocitymortgage.com. Right below us there. Please also put the acronym ORAAT in the subject line, just so I know that, and it'll also help to filter out the multiple amount of emails I get a day. Other than that, also please leave your best phone number I can reach you back at, because I talk much faster than I can type typically. So it makes it a lot easier to try to, reach people back in a timely manner, because sometimes the questions of the emails are back and forth. It's just like, million, you know what I mean? So on any given day, I get about 200 more emails. So it just sometimes gets lost in the mix. So
very cool. Well, thank you for being a part of the channel, helping out. You got yesterday, somebody posted in the group, gave you some rave reviews. So congratulations.
Thanks, Mike. Appreciate it, man.
You got it.